Let's talk about why we brought you on this morning. That's what we've seen happening in 2022. Obviously, you've lived through what happened in the year 2000. That's when we had day traders. They all kind of disappeared after the dot-com bubble burst in 2001. We have retail traders now. We don't call them day traders. We call them retail traders. And these people have seen some severe pain, just like every investor has over the last many months. What's different now versus 2000? What's the same?
I think what's the same is, first of all, as you pointed out, everybody got hurt. It's not like just day traders and retail traders got hurt. Everybody got hurt. I think the phenomenon is the individual trader, the trader per se. So back then, what the trader has, what's the same is they had 4 or 5 years of an incredible market because of the internet that allowed people to trade online. So that's what day trading became a pretty good phenomenon. Today, we've had a pretty good last 4 years or so. What happened then, we have the dot-com bubble burst. And that lasts for 3 years. And now for the last 5, 6, 7 months have been really, really difficult. What traders need, what a day trader needs, or retail trader needs, he needs or she needs a bull market. When things are going well in the marketplace, people that trade regularly every day do very, very well. When things don't go well in the marketplace, they suffer. We pretty much wiped out all the retail traders back in 2000 to 2003. And I have no doubt at least 50% of the traders that existed 3 or 4 months ago are thinking about whether or not they should even be in the business. One of the other things different today, though, is the retail trader is a little bit better organized. You've got better technology, you've got better risk management tools. You get price improvement on pretty much the majority of your trades. The trade happens almost instantaneously, and you get it for free. So that would be one advantage today for the trader versus a couple of decades ago. But in both cases, it's really painful.
Joe, the big question for the markets as a whole, also for a lot of the firms that have been kind of rushing to serve that sort of retail customer that was interested in free trading, frequent transactions, weekly options, all the things that were very easy, but maybe were not as fun anymore when the market's going down, is can they be converted over into longer-term investors? There's tons of tiny accounts out there at Robinhood and other firms. They would love to just be kind of a all-in-one financial home, a hub for these people. But what are the prospects that can happen? Because we talk about free trading. It's never been cheaper to be kind of an easy buy and hold, just lock into an ETF portfolio for the long-term investor either.
Mike, I couldn't agree more. I think, first of all, it's never the situation for the individual investor or the retail trader has never been better for the reasons we've talked about. Secondly, when we talk about Robinhood, who really caters to that type of trader, I think Robinhood's got to do a better job of diversifying the revenue stream. So I know about adding the derivatives and adding pieces of that, but people really have to learn and be comfortable what to do with them. And frankly, they can think about those instruments more in terms of being able to hedge and things like that. The vast majority of the retail trader, though, has not learned that yet, in my opinion. I don't believe that. And we need to do a better job helping providing them with information and tools that help them learn that. The issue that you talked about, I think over time, especially if you get whacked around in the market a little bit as a day trader and you start to learn more about the markets, I think you start to learn a little bit more about the wisdom of what it is to become a strategic long-term investor. And the first part of that is making sure you have a discipline. And the other thing that would help investors today is you're not trying to pick a bottom, you dollar cost average in. And those are all very, very, very strong principles for any individual investor and frankly, for many institutional investors as well.
You know, the reality is we saw a lot of investors who got burned so badly in 2001 that they walked away from the markets for, 10, 15, 20 years. Maybe they haven't come back in.
Yeah.
This is a whole new generation. Are they going to have that same bad taste in their mouth? Are they going to be turned off to the idea of what it means to be an investor? And will that hurt them from the perspective of not being savers? What does that mean for market levels overall?
Yeah, the dot-com bubble burst in March 2000. And that recession was very serious and it lasted 3 years, right? So far, what we've been going through now has been very difficult this year. But we're not close to 3 years yet. So the pain you feel over a 3-year period is what pretty much wiped out the retail investor back then. We still have a little bit more time to go before something like that happens. But there's no question, Becky, that many of them have really been hurt. And I have no doubt that some of them have already left. But it's not as painful for as long as what 2000, 2003 was.